Hey traders, what's happening? Coming at you live from Lake Superior in gorgeous Upper Peninsula of Michigan and streaming across the planet. This is Shane with Futures IO. Thank you for joining us for our 434th webinar event and our very first FIO Happy Hour. Jam Croissant is legendary in his field, and he is here with us today. A couple of quick words about Futures IO. We're a trading community that's dedicated to transparency and bringing you quality education with webinars such as this. The basic membership is free. Our YouTube channel hosts over 400 trading videos. It's a great resource, and it's all free to the public. Check it out, subscribe for all the latest updates, and do us a big favor by hitting a few like buttons while you're there. You can find us on Facebook, and for daily trading insights, you can follow us on Twitter at FuturesIO. All right, folks, we got a lot of ground to cover here. You can click on the Q&A button and type your questions in there. We're going to do our best to get to as many of them as we can. Unanswered questions are going to be posted on the webinar thread for follow-up. The event is being recorded, and we're going to do our best to have it up on the Futures IO website and on YouTube within 48 hours. And now, without further delay, please join me in welcoming Jam Croissant. How's it going, man?
Good. Thanks for having me. Looking forward to it.
Right on. Hey, you know, I'm a simple futures trader. I was mentioning that before here. I know just enough to be dangerous. Fortunately, I brought along my secret weapon to help with my ineptitude on the subject. Longstanding Futures IO member Josh is here with us as well. Josh, what's happening, man?
Hey, guys. Glad to be here, Shane. If I'm your secret weapon, you may be in trouble, but I'm happy to be here.
Right on, right on. Okay, well, it's happy hour. Let's pick some brains. Jim, a lot of futures traders, myself included, they're just beginning to understand the importance of how hedging activity affects ES, SPX. How does dealer positioning impact the futures market?
Yeah, so options skew, which I think is the most important factor for driving options related flows in the underlying assets, is always to the downside, has been since the beginning of time. Why? Because the world is long and everybody is, long stocks, long assets. If you have a job, I've said this before, you're long. If you live, you're long. You own a house, you're long. And so everybody ultimately needs to hedge their risk to the downside, not to the upside. That leads to strategies like selling calls or overriding calls for yield, right? As well as buying puts and downside protection to protect yourself. That drives option skew. Option skew means options on the downside, outside of the money, are much higher than to the upside, which are much lower. There's a much higher price to that insurance. Ultimately, when somebody wants to hedge themselves, the dealers or market makers or investment houses that warehouse that risk have to hedge that risk. They're ultimately short put, long call out of the money. And so how do they hedge that? They hedge that by being short the market. And it's a great trade because they're selling a high vol, they're buying a low vol, there's a yield there, there's a carry to the trade. And it's a great business. The only thing is, as time passes, the options expire. They have a time to expiration, right? And as those things move forward and expire, those short delta hedges against those positions have to be unwound. And they don't just have to be unwound based on time. That effect is charm. That's the term, the Greek term, for that effect, per passage of time, the change in delta of options positions. But also as volatility decreases, right? Same thing. Those options they go down, and that amount of hedging decreases. That's called Vanna, right? Those are the Vanna effects. So as volatility increases and time passes, these options that are out of the money disappear, and those hedges have to be unwound at the end of the day. And because skew is always to the downside, that buying back is almost always, I can say always in history, has always been in the indexes and equities writ large, buying back stock. And that creates certain natural effects that you can depend on. They waver in terms of how strong they are based on where the open interest is and where the positioning is biggest, right? They waver based on how close you are to those expirations where the biggest open interest is, and how much volatility is moving and what levels volatility is at. But ultimately, that's what's driving this. So to the extent you can understand what that positioning is, where it's located, and also what's happening to volatility, you can have a very good sense of how much flows are going to come out of that complex. That complex is getting bigger and bigger. right? Options volumes are exceeding equity volumes at this point, right? They're a major driver of underlying move. So, understanding how they work, even if it's just broadly understanding the big expirations and how those flows might be related to them, even if it's just following general trends, is a very important thing, I think, for futures traders to understand.
Yeah, definitely something that we are probably going to want to be aware of. It sounds like.
Does that make sense? Everybody kind of follow what I'm getting there? Any follow-up questions?
Well, sorry, Shane, can I jump in?
Go right ahead.
Yeah. I mean, you've talked about this so much. It's second nature to you. This is your space.
Sure.
For a lot of traders who, especially say futures traders who are not big options traders,
right?
Maybe it's good to take a step back and just examine the foundation a little bit. Even just from the perspective of let's say when you buy a put, right? You're effectively, if you buy that put from a market maker, you are effectively taking liquidity from the market, right?
Right.
Can you talk about that just a little bit? I mean, just to kind of back up a little bit, you talked a lot about Vanna, Charm, Delta. Maybe just kind of take it, zoom
a step back. Yeah, absolutely. So, I ran one of the biggest market making shops in the equity index, and I can tell you exactly kind of how it happens here. So you come to the market, whether, in the old days it was you pick up a phone, but let's kind of go through that because it's a little more physical and people can imagine it. You pick up a phone and you say, hey, buy me the August 4,300 put. Okay. And it's a 10 delta put, right? The first thing the market maker does who decides to sell it is let's say he sells 100 of them. Okay. Say you're buying 100. He goes and sells 10 futures against it, right? Because it has a 10 delta. It's 1/10 of the underlying.
And Jim, could you even clarify for those who are very new to options?
Sure.
Explain what a 10 delta is. Just everybody may not know.
No, it's a great question. So a 10 delta, it means it has a 10% probability of being in the money, right? It's also what it actually, that's not the official definition, but that is kind of a conceptual way to think about it. It actually means per dollar that the underlying moves, right? That option changes by 10 cents. So it's almost, think of it as it's 1/10, right, of the exposure of the underlying, right? Per dollar move in the underlying, you get a 10-cent move in that option, right? So it's a 10 delta. It's the amount of exposure that it has to the underlying. Now that option has other exposures. It has vol exposure, right? It has, that delta changes. So as you get closer to the money, that you have gamma exposure, which changes that probability of being in the money from 10 to 20 to 30 to 40 to 50 as you approach it. 50 would mean that you're at the money and there's a 50% chance of it going either way. And the hedge for that is half of an underlying to put a volatility trade on. And when an option is hedged, it's a volatility trade. Right at the end of the day, if I buy a call, that's a 50 delta, and I buy a put, that's a 50 delta. It's a V. You make money in either direction, and the cost of it is ultimately the premium that you're paying for that straddle.
Okay.
Yep. Cool. So they come in, they say buy 100, you sell them 100, you're going to go hedge it in the underlying. At that point, it's a vol trade, and you're long. In the case of the market maker, you're short the volatility. You probably don't want to just be naked short volatility, so you're probably going to go buy volatility elsewhere where it's cheaper. Maybe somebody on the other side of the bid or in some other market is selling it to you, and they're selling it to you on the bid as opposed to on the offer. Maybe you'll take that in, right? Move those positions accordingly and hedge that the other way, right? So kind of gives you a general sense of the general mechanics of how these things work. Obviously, as a market maker, when you go sell that, you're putting orders into the marketplace. And I've had questions there with, well, okay, there are these Vanna and Charm flows, but what happens when these trades are originally initiated? What about all that flow? And the reality is there's always a general amount of index positioning, right? And it changes and ebbs and flows, but that skew positioning is always decaying. And broadly, as hedging comes off the books, people are coming in and hedging more and replacing it. So a lot of the Vanna and Charm flows and the flows that come off that actually get somehow replicated with options flow, right? So it may be, again, somebody coming in and buying back the puts that are decaying, right? Which then gives the market maker long exposure to the market, right? So the point here is it's the change in that positioning that's constantly what's important.
Cool.
Yeah.
And just to follow up on the market maker part of it, there's a lot of people, I think, in the trading community who probably they understand maybe what a market maker does, but I think it's misunderstood. Being a market maker and being 13% of SPX index volume during the financial crisis time, like you were, from your perspective, it's not just as simple as making a market, right? There's a lot more involved than to managing your risk. Could you talk a little bit about that?
Yeah, so a market maker framework, which I think is a very important thing for people to understand, is it starts with drawing volatility surfaces. Okay, so let's start. What is the volatility surface? So, like I was saying before, every option has a different implied vol that it's priced on, right? The price of that option is dependent on the odds, right, of the risk of the move, the realized move underneath it. And there's more of that to the downside than the upside based on supply and demand. That creates at any expiration what's called an options volatility smile. It's more like a smirk because of the skew, but essentially it's a smooth implied vol for every strike, right? From call out of the money to put out of the money. And that smile, when extended over time, over every expiration, creates a three-dimensional surface. It's a series of smiles. That volatility surface is smoothed by market makers, right? Everyone has their own kind of proprietary kind of way of fitting the curves. They fit it, and they are constantly trading along that volatility surface to sell what's high, buy what's low, to absorb liquidity. On top of that, that's one product. That's the S&P or Russell or OEX or bonds or whatever product it is. You're then connecting all these volatility surfaces, right, across one another. So they have different correlations. The S&P has a certain percentage of the same stocks as the NASDAQ, right? And the ones that aren't in the same two indexes have certain correlations. So they're playing correlation models to hold these together, both in terms of at the money and across skew. I know this starts to sound complicated, but at the end of the day, they're tying pricing on a relative value basis based on fundamental pricing as well as historic correlations across one another. And they have this massive relative value framework. Every good market maker has their own kind of breed. They do it in slightly different ways. But the idea here is to look at a relative value framework and constantly find what's high and what's low, and try and extract yield to the best possible and absorb liquidity when people are willing to pay over, right? What that relative value is, be willing to give them some. The higher over it is, willing to sell more, right? And they're pricing, and they're set with hey, if you're going to be a market maker, you have to set a market. They set markets on their relative value. And if they trade enough around these relative values over the long run, they should extract a bid-ask spread and a yield that ultimately makes money.
Cool. Okay, cool.
Yeah. I have a lot of complicated details, I know, but at the end of the day, it's not, these involve big systems, a lot of data, and the more information you put in, the more analytics you've done, the better your model and the more yield you can extract from the marketplace.
My brain is melting.
If it were easy to be a market maker, everybody would do it. In other words,
that's true.
Speaking of that, you were in the actual pit, right? You were in the pit.
I was early on. When I started I was training in 98 and started trading in 99. So I cut my teeth during the tech bubble, which is kind of when was my first kind of trial by fire, and then stood in that S&P pit till on and off till when was it 2009. Moved upstairs in late 2009, 2010 for my firm, and then I moved to kind of my money management firm in 2011.
When I think of pit traders, I think of they're kind of rough guys. You seem a little. You seem a little tame. Did you just mellow out?
Yeah, I'm 44 now, so there's some stories. I think some people have told stories on Twitter too. I think I was the furthest from smooth around the edges when I was down there. I definitely, you can't be 13% of the volume and not be a little bit combative during financial crises when you're battling over millions of dollars. But the reality is, the SIBO, where these options were, and for the most part, options markets are a bit more, the want to offend any futures traders or commodity traders, but there's a little bit more a quantitative side to it. So you tend to get a little bit different type of trader in there. I would say on average, there were definitely exceptions to that rule. But yeah, I mean, look, if you want to do, again, like I was explaining volatility surfaces and understand the dynamics, it does take a little bit more of a quantitative approach. But there's definitely, when I first saw, this is a good story. When I first came down to that trading pit in 99, the guys I worked with, I was by far the shortest. I'm 5'11" and change. The guys that would go down, the 6 guys that would go down every day, the next shortest was 6'3". We had a guy that was 6'7", guy that was 6'5". It was a bunch of Ivy League athletes, basically. It took a certain breed, and I'm standing there in the middle of a forest, right, of human beings, and you don't get on anything without being faster, louder, more obnoxious, yet, whatever it takes. It was a different thing when I started. You go down there now, it's a very different story. It's, definitely, bigger brains, less height. But there was a lot of that early on as well.
Yeah. Shane, if you want to jump in with questions, go ahead, man. I'm just going to roll. I got another question for Jim. If you,
I know you came prepared, man. I'm going to work off the list here a little bit. We'll do some upvoting on the questions here. So popular ones. Defrigerator wants to know if he buys 100 calls on Schwab, are they hedging immediately or are they waiting for large batches?
Immediately. And it's instantaneous. And actually, I was giving you an example from a pit trading perspective, so you can more kind of visually understand it. But nowadays, automated. Citadel's taking that order. The second it goes up, actually, they're probably even seeing it before it hits the market. They're hedging it, right? I mean, that's the beautiful thing about Robinhood for these guys. Yeah, you're not paying Robinhood an exchange fee, right, to execute, right? But you better believe you're paying in another way, and that's that those orders are being seen through dark pools at Citadel before they hit the market, and they're hedging out in front of it, just like all high frequency trading has become for stocks. And so, yeah, that hedge is probably done before that trade ever even happens.
Right. All right. How about Yola Quant? How do you evaluate whether some of the other Greeks are under or overpriced, particularly Gamma?
Well, there's lots of different ways to skin that cat. There's lots of different ways to kind of perspectives on that, right? Implied vol ultimately by expiration, whether it wins or loses is a function of realized vol, right? So when you make a vol trade, the question is, did you have more volatility than it was priced at, right? So to the extent you can look at historic versus or project realized volatility in the future, that's a good way to kind of judge whether it's high or low, right? But there's no perfect way to do that. There's another approach, which is relative to its cohorts and relative to again, we're talking about a relative value framework, right? How can you judge whether it's high or low? Well, if I can buy something cheaper right now, I don't need to predict the future, right? Right now it's high, and I can go buy things that are cheaper and kind of hedge out my risk. Ultimately, it doesn't matter what the realized vol is. I'm hedged in theory, right? So, what a market maker does and seeing whether it's high or low really is at this given moment, try not to predict. More and more, though, the good ones are also doing a bit of prediction because they're also taking positions and trying to get out ahead of these things. So hopefully that's a good enough answer. But again, it's a function of its relative value at any given moment, as well as relative to what you think the outcomes are going to look like.
Seems like a moving target.
Yep, for sure.
Trade 4M home. You often refer to watching fixed strike vol. Could you explain a little bit of that?
Yeah, really important. Most of the vol world, or people outside of the kind of the immediate vol world, really see volatility as just a theoretical number, right? What is the market pricing for expected volatility going forward, right? And that's what the VIX is. The VIX is a measure of floating vol, of what is expected generally right now at the money. So, but like I was mentioning in the options chains, when you're looking at the underlying vol, that vol is different by strike, right? So out of the money put has a higher implied volatility than an out of the money call does, right? So as I move down towards that out of the money put, let's say we're trading 4,400, and let's say the market moves to 4,350. The market drops by 50 points. The 4,400 strike might have a 10 vol, might be on a 10 vol, right? But that 4,350 strike maybe was on a 15 vol. Okay, it's on a higher vol because it's out of the money and it's a put. As I move down to 4,350, I've slid down the curve to a 15 vol, right? The VIX has gone up. But in terms of underlying vol pricing, the vol hasn't moved if we're at a 15, right? People are pricing it as, oh, vol's gone up by 50%. To your vol trader who's trading in there, they know that, actually the vol hasn't gone up. Nothing has really changed on the fixed strike level, right? And in terms of supply demand there. It has gone up in terms of what the expected vol is at that point. But in terms of value, whether or not pricing on the vol space has gone up or not, that was the expected increase. So you've just kind of gone down the curve. That is fixed strike vol. What those the vol of that fixed strike was, right, that you've now moved to, is what measures fixed strike vol. Floating is where is it at the money now versus where it ends at the money tomorrow, right? It's a much more kind of theoretical. What is vol? Where is vol, right? As opposed to where has vol gone, right? And for a market maker, somebody who trades vol, to me, it's actually more important, and actually very importantly, and this is kind of a little inside thing, more important for predicting, right, as a signal, right, to look at fixed strike vol, because that's actually telling you about vol supply in the market, right? If the market's just sliding down to that 15 vol, the market's down 50 points, yet vol's not coming up, it's just kind of sliding down its curve. There's no panic. There's no, right, like vol's not really moving. If anything, it should probably be going up relative to its value, and it's not. It's probably a good sign for what futures might be doing next, right? Or where panic is or what people are seeing. So as a market maker, and any market maker will tell you this, particularly options, right? You're really focused on fixed strike vol because that's what's affecting your P&L. That's what's affecting how options are actually moving, right? As opposed to some theoretical idea of what expected vol is. They're both important, but different things that have different values.
In other words, VIX is a moving target. And the fixed strike, if it was 15 and when you 50 points lower, it should be higher than 15 if you're looking for a continuation. Right?
Yeah, it should be, you would think, right? Because at the end of the day, if people are short that vol and it's sliding down there, that's what drives the panic, right? People aren't hedged. And it should go up based on that, you would think, on a supply demand basis, right? And generally in stressful times, it does by quite a bit. But if you're just kind of sliding down that curve and sticking to that expected pace, or even sometimes it goes down relative to that, like it was a 10 now, you slid to a 14, the world's out there, oh my God, the fear index is up 40%. And as a market maker, you're like, no, actually, vol's actually down in real terms relative to where it was priced, and people are not panicking. And this is probably going to go right back up, right? So that's, again, it's all relative to expectations and positioning that's important as a signal. And so fixed strike vol is much, much better for a signal.
Very cool.
Yep.
Hey, Josh, do you have one? I need to go get a refill on my water.
Yeah, go ahead. Well, so there's one question on here about order flow and stuff. In the futures world, at least, people throw that term around all the time. Order flow tools, analytics, and it's used to sell a lot of products. Ultimately, of course, capital flows mean that, there's a trade at the bid of the offer, that there's a transaction that results from it, but it's a lot more nuanced than that. Can you talk about different types of flows in the market? When you talk about flow, you talk about structural flows and you talk about other types. Can you tell us, when we talk about order flow and the whole picture, what are we really talking about?
Yeah, that's a big question. There's a lot of different flows, right, in the marketplace, and even just in vol, there's an inordinate number of different pieces. I mean, I can start from the beginning and name some of the big ones, but you have these options flows, which we've talked about. Even just on the options side, there's call writing strategies, right? There's callers, right, that come into the marketplace, like big caller trades that are driven. There's outright, just in the options market, but there's rolling of put strategies that come through that you get to know who are the players and how are they coming through and when are they coming, right? Those are all important. But that's just on the option side. Then there's the whole ETF, ETN space. Who's coming in and buying not just the futures and how are those futures moving relative to one another, but all of the options on those futures, right? So all the VIX calls and the convexity that comes with that, modeling those relative. Now we get to the over-the-counter market, right? And the over-the-counter market, you got auto callables, you got all of these structured trades from banks that have very, common, cadences to them, and then they ebb and flow. There are times when there's a lot more, there are times there's less, but there's also movement of them, and particularly lately, to more tied to American indexes. Used to be more tied to Asian, European, but then you have certain countries where they're bigger and they're more prevalent. Korea has a huge auto callable market, the Nikkei as well. So understanding those flows and where they are and how that affects the broad picture, very important, right? This is just the vol spec. There's click add options, which are huge in certain areas, right? And are having major effects. But again, you get more in the weeds. There's all kinds of different flows. The key here is to try and understand how they are, how they're managed. They're not all vanilla options. So the hedging activity on them for particularly these over-the-counter products can be very nonlinear, right? You can be no hedge, or selling vol for the bank, and then all of a sudden buying it all back, right? Just because of the structure. So again, without getting in too much in the weeds, it's a big, complicated market. When I look at flows, I don't just look at the options markets either. I'm looking at other quantitative strategies, other things that, and again, I know this isn't in the vol. A lot of these kind of vol, services that are telling you about open interest and gamma and Vanna or whatever effects, they're not picking up on a lot of the other flows. And there's trend following, vol targeting, risk parity flows that come in at certain intervals, right? Based on positioning and knowing who the traders, what the strategies are, what's the AUM increase, how underinvested they are, and what the market's doing. And at the end of the day, the way I see it is markets aren't about fundamentals, they're about flows. Who's the buyer, who's the seller? Mm-hmm. And to the extent that you can measure more of who's buying and who's selling, you can get more of that pie and understand, how they react, what their reaction functions are. The more you understand what the cadence of the market and what the likely outcomes are, and it really gives you an edge.
So my takeaway from that, Jim, is that the market is a big beast, and it's not as simple as people tend to make it, right? They look at a chart and they see buying, and they don't realize the complexity behind that. And we try to make it as simple as we can, but often it's not that simple, right? And there's a question on our chat that kind of relates to that. You have a 27-point model, right? You're heavy into the quant. How can we, who are not developing 27-point models, what can we do? How can we benefit the most? And maybe the answer is, hey, you can't. But what can we do?
No, absolutely, that's not true. It's just like anything. It's not like, hey, I can't become a nuclear physicist, so why bother learning about nuclear physics? Understanding, even in basic terms, how the world works will give you an edge relative to complete naivete. So, there are trends to these things, right? That you can, if you understand them, that you can take advantage of. Not knowing these things is a disadvantage. That doesn't mean you have to know. And I think this is true with most things, not just trading, but 80% of the value of things can be learned relatively easily. Usually it's I have 27 factors, but candidly, 5 of them probably represent about 60-70% of the value, right? The rest are taking me to that last mile, right? And so, you can get a lot of value out of understanding these things by following trends and understanding general positioning and almost having some toy models. And people have shown that. Like, there are people who are relatively new to trading, right? You can go on Twitter. There are people with almost 100 more followers than I have, right? That have been probably trading for less than a year, and they have developed some pretty good models, right? That are providing value to their followers, and people get value out of, right? Even again, not talking more about anyone. Like, there are people providing services out there. All products that they themselves will tell you those are very naive products, and that they never were a market maker. They never had the trading experience. They did some quantitative work, learned about these things, and rolled out some systems that thousands of people use and get value out of. They may not be getting that 100%. They may not have the 27 factors. Doesn't mean those things aren't valuable. And so, yeah, I mean, at the end of the day, you learn what you can and you use what you can, but this stuff is very important.
Mm-hmm.
Yeah.
Hey, Jim. Hey, Snacks. Good to see you here on the program. Snacks is asking, assuming that many of your models are based on data that may be difficult for individual traders to acquire, either because it's expensive or for some other reason. In your experience, have you found reasonable approaches to build quantitative models based on data derived from other representations of supply and demand, like price action, order flow?
Yeah, absolutely. Again, the more you have, the better you're off. But things like just broad volume, open interest, right? Understanding kind of relative value pricing, things along those lines can give you a lot of insight about how positioning might be. And you can correlate those, right, relative to outcomes and look at trends. I mean, you don't have to be a statistics PhD to kind of run a linear regression, right? You can go find general correlations and trends and tie those to these types of open interest and volume things, and those will provide you some value, right? And not just minimal. Like you can build some pretty cool toy models with very basic kind of statistical relationships once you start pulling these factors in and start looking at them as part of your data set. You don't have to have real time. You don't have to get the over the counter kind of click add option kind of volume to understand kind of that some general positioning in a certain area is likely to have some effects. So just like anything, you got to get in there and get the best data you can and tinker with it and try and apply kind of relationships and understanding of how those things move. But at the end of the day, a lot of technical analysis, the reason technical analysis works, which people don't really realize, it's not magic. There are structural flows. They exist. And those things express themselves in some type of trend, right? And technical analysis is one of the few things in finance where people are actually using time, right, as part of the analysis. It's not just buy, sell, it's in terms of time. And a lot of these flows are a function of time because they have expirations, because of the way things are priced. So those trends tend to happen over periods and tend to work in certain ways. So people catch some of that with technical analysis, whether they realize it or not. So you can again follow trends, take more data like I'm talking about that has to do with volume and positioning in these vol spaces or other areas, and start adding that to your kind of trend models, and you'll add value.
Cool. Speaking of time, we got another one here. Bumblebee RR. Are there certain times of the trading day or even regular trading hours versus extended hours where options dealers would be covering their short positions as volatility and time decay?
Yeah, I actually talk about this a decent amount on Twitter and in some pods. But so first of all, first thing you need to know is, yes, there are, but those times and the effects on those times are very much, they're stronger during periods where these effects are stronger. So I think just following a certain timeline every day can get you into trouble, right? But if you're in a period with strong Vanna and Charm flows in terms of calendar flows, like I was talking about, if you're able to kind of get a general sense of when those periods are, during those periods, the time in the day when those flows tend to happen, because of the way banks and big warehouses of this risk tend to rebalance their books, tend to fall in certain windows. Again, it's not like anything. These are trends. These are not like, oh, if you go buy at this time every day, right? It's not going to work as well. Those times tend to be around the opening of U.S. trading, right? The close of U.S. trading, and overnight the European trading open. Okay, those are the big ones. The U.S. open and close. This is when the rehedging happens, right? People start to look at the end of the day at their vol books. They start to take the time out for the next day, 2:30, generally Central Time. I'm on Central. A little egocentric here, but around from 2 p.m. to 3:15, which is the options and futures close. That window, Central Time, is a big kind of rehedge of Vanna and Charm time. Same in the leading into the open. So 7:30 a.m. till about 9:30 a.m. And sometimes that's 8 a.m. to 10 or 8 a.m. to 9:30. But that general window, right around the hour before and hour after, that tend to also be very supportive for Vanna and Charm flows. Again, during those windows when they're the strongest is really when it matters. And then again, the overnight 1 a.m. Till 2:30 to or so, maybe even 3 a.m. Central time. That's around the European open. And why the European open? Again, American vol markets are dominant, so the open and close matter. But that's when volume for options comes back online enough for dealers to kind of see where the vol has gone and to rehedge if you're on the American shores. And again, it's a big vol market in Europe. The rehedging of those books happens then as well. Again, it's not to say there's not hedging in between, but that's when the biggest hedging flows happen. So you definitely see more effects during those windows.
Josh, you look like your gears were turning, man. What do you got?
Oh no, that was exactly one of my questions, and I was asking specifically about 2 a.m. Eastern, 2 a.m., 3 a.m. European time as well. I did have another question. Can I go ahead and ask that, Shane?
Dude, go right ahead.
Yeah. So I'm going to go ahead and throw this out here. It's not quite related to that. You talk a lot about the 20-day, and you mentioned this, 2 standard deviations, which is pretty normal. But you also mentioned the 1.5. I've never heard anybody talk about the 1.5 sigma. Why 1.5?
Yeah, you think that one's weird. I use the 2.3 standard deviation down too.
Oh.
I don't talk about that one much. It doesn't come into play that much, but it's a very important one. The 1.5 standard deviation up is the idea there, and none of this stuff it's all trend, right? 2 standard deviation is kind of the cap. And why is that the cap on markets generally? That represents, 2.5% on either side, right? 5% of the distribution, 2.5%. Once you get to that point, 97.5% of occurrences, right? That's really high. And not just that, the world is long, right? We're all tend to be long. And if you're not taking profits, or if not, somebody isn't taking profits at 2 standard deviations up, right? Like there's always going to be someone there taking profits because the world is long. So that provides a very solid cap historically. Like that's a great level to kind of for resistance. If the market's approaching that, it's showing significant strength, right? Not just kind of, oh, it's strong, but if you're up in this channel pushing that 2 standard deviation, is a very strong flows, very strong technical kind of signal, right? And so what that 1.5 does is it really gets you kind of, there tends to be a channel there when the market's strong, where if it's closing above 1.5 standard deviations, not just hitting it, but it's closing above 1-2 days, right? Just like anything, it's a very strong signal for flow and strength, on a technical basis. So that 1.5 we use really as like this signal of the market's showing significant strength relative to its moving average, to its monthly moving average, significant the kind of thrust and of flows.
But you said that the 2 standard deviation up was kind of a take profit for a lot of people, right? Mm-hmm. So are you saying, we close above 1.5 and that's strength, but what about when we get too close to that second? I mean, I think that often strength begets strength, right? I want to be
clear. I'm not telling anybody that they need to be selling at 2 standard deviations up, right? I'm saying that there are plenty of flows coming in, right? For profit taking. Again, when the market's strong, the general kind of zeitgeist tends to be you buy the dips, right? And if you're buying the dips, you're going to take profit somewhere, right? On some of it, you may be over levered, you may be 1.5x, right? But people are taking profits there. So there's some supply there at 2 standard deviations up is the point. And it's hard to kind of push through it. That said, when you're looking forward days, weeks, that 2 standard deviation up, if you're in a positive trend, it's going to run pretty quickly to the upside, right? And to your point, the 1.5 standard deviation, what it tells you is this is a strong trend, beyond trend, right? Follow it until it breaks. You may be buying that dip. And again, it's not like it's going to always, I'm not saying buy that dip at 1.5 standard deviation. I'm saying if you're closing above there, you want to be in that kind of regime and that kind of mentality.
Okay.
Yep.
Yep. Gotcha. Yeah. Shane, do you want to take a question or something?
Yeah, absolutely. I'm going to shift gears on you. We were talking about regimes, and it's my understanding that you kind of possibly feel that we're approaching a regime shift. How do you think that's going to affect how do you think it's going to affect passive versus active management techniques?
Oh man, you've been reading my macro stuff. That's a long conversation.
I figured you want to dip into it maybe a little bit.
I'm happy to. I love that stuff. That's my first love, honestly, is macro. Before I ever got in the option space, I kind of lived all over the world and loved kind of policies. So I love macro. Yeah, without diving in too much, what you're touching on there, Shane, is my view that we're getting a shift broadly globally towards demand for reducing inequality, for better or worse, non-politically. There's that push for that, and that's driven from both sides, left and right. A increase in populism, increase in policies that are more likely to kind of not give money through monetary policy or supply side economics for lower taxes for companies or lower interest rates, which go to corporations and wealthy primarily, to payments. So we're getting more of that. COVID has accelerated it. We've had more than $6 trillion of fiscal spending, which is about 7 times the size of the New Deal. People don't realize the scale of that in the inflation adjusted terms, 7 times the New Deal. It's about 7 times what the response was, or 6 times what the response was to the 2008 financial crisis. So huge fiscal stimulus, and there's about another $1 trillion coming in with a new infrastructure plan, not to mention another $2 trillion right behind that, potentially. And that's politically very popular, whether people realize it or not. On both sides, people like getting money, whether it's PPP or, and there's some politics around that. But politicians like giving their money to their people, and people, when they get it, like it, whether they have concerns about the debt or not. Generally, that's a positive thing. And once that gets started, it tends to have legs. Historically, these are cycles: supply side economics, demand side economics. Money going to capital versus labor saying, hey, I've had enough, kind of, what about us? And so we're in a cycle where for 40 years, we've had massive supply side economics in the form of, lower taxes for, flatter tax rate, dramatically so. And then also in terms of interest rates. So interest rates have dramatically declined since 1980. And so, the net result of that is if you give money to wealthy people, they spend it on assets. They don't spend it on goods because they've already bought all the goods they need, maybe luxury goods. That the more you give it to the average person, the more they're going to spend it on goods. And so the more these give it to people, it more causes inflation and also higher interest rates in the long end of the curve. The Fed hasn't had to worry about their dual mandate of interest rate, of inflation versus kind of labor growth. Now, all of a sudden, with inflation heating up, they're going to have to worry about it. And so ultimately, that means higher rates at the long end of the curve. That means lower demand for assets and more demand for goods. And at the end of the day, with multiples where they are, lower interest, higher interest rates, less Federal Reserve monetary policy, less supply side economics, secularly for the next decade is likely to mean less demand for assets going forward. Doesn't happen overnight. This is how adjustments to bubbles, why bubbles happen and how bubbles get resolved. But that's likely to be the thing that ultimately pricks this liquidity bubble, is less liquidity. And that less liquidity is likely coming from fiscal policy and inflation. So
I think it's a fascinating conversation. And basically you argue that companies like Amazon and Tesla would have been out of business long ago, not for the free money.
Yeah, I mean, now they're fine, right? They've gotten to scale where they can make money. But all the companies of the future, we've created a technological revolution. This is why I say I'm not. This isn't a political argument. There are lots of good that's come from monetary supply side economics. Mm-hmm. It's created a technological revolution. Mm-hmm. These companies never would have existed. But that's ultimately very deflationary, right? Because they're, big box stores are gone, right? All the people that work there are gone. Taxi drivers gone, right? All these things are deflationary. Ultimately, new technology, new things, yes, we benefit from them, but at the end of the day, it's tough on labor, right? And really, the benefits of that accrue to these corporations and the owners of those assets, right? Whoever owned Tesla, done very well. Whoever owned Amazon is crushing, maybe not today, but every other day, right? And so at the end of the day, that's what drives wealth inequality and drives a lot of these issues that ultimately have to be rebalanced. So Yeah, I mean, again, and that's going to be tough. There's going to be a lot of creative destruction for corporations that are getting free money that don't have to worry about making money today because they've been focusing on eyeballs or building that down the road. Those corporations, when liquidity comes off the table, will go out of business. There'll be a lot of them. We saw that in 99, right? 2000, during the tech bubble. This is how trends kind of work. And we're at historic liquidity by all measures. And so pulling off of that relative liquidity is going to be a problem.
Can I ask you about a specific trade that you've talked about? The JP, the hedge equity.
Yeah.
So
I think they hate me, by the way. I think I've made this so public at this point that
okay.
they're actually changing their methodology. I don't know if you know that or not. They went from doing this once every quarter to doing it every month now, and they're trying to reduce the impact because so many people are talking about it. But
that's the Jam Croissant Effect. That's what this gets you right here.
Oh, you brought the croissant. I love it. You came prepared. Props. Oh yeah.
I thought about wearing a gorilla suit, but I thought that was
amazing,
maybe
Josh.
a little far.
I'm a fan.
So it's a 34, 25, 40, 65 put spread, and they're short the 44 30s for the quarter. So one question is, it's a huge trade, right? It's 45,000. One obvious or one really dumb question, which has an obvious answer, I'm sure. If everyone knows about this, why don't they just go after them? Or is it just a case that they're big, but they're not that big?
Yeah, no, look, it's massive, right? And to the point where people are holding the other side of that. Like the whole market is saddled with this other side of the position. And when I say this whole market, it's not one entity; it's the whole market. Like it's across the market. They ultimately. Yeah, I mean, and the other thing about it, I think it's important. It's not. The other reason I think maybe the market would go after more if it was one entity that had that exposure. It's not JP Morgan with exposure. This is an ETF. There's all kinds of people invested in this strategy. So it's not like they're going to liquidate if that strategy gets hit. Those people will take some losses and they'll decide whether they want to redeem a little bit next month and do, whatever. Right. Yeah. But, if it was a trade like we've seen in the past, like, there have been plenty of examples. I won't get into all of them, but I think, the ARC trade, which I've talked about as a potential kind of structural issue, that's one entity which could implode overnight if things went poorly, right? Mm-hmm. This is really more of a diverse spread kind of hedged returns strategy. The other thing is it's levered relative, that strategy, even though it's huge for the market, levered relative to the assets they have. They're net writing one call. They're not overwriting calls, right? They're net buying one put spread relative to the assets in the account, right? Yep. So they're not leveraged as a strategy to a point where they're going to have cataclysmic losses. They're just going to tap out their gains, right? Or protect their downside. So the way it's structured just is not something that is going to cause a liquidation event or stress in the market.
Got it.
Yeah. Go for it. Fascinating stuff. Hey, you know what? Top question at the moment. Thank you, Odysseus. Would it be possible to explain a little of what you think might be going on in the ES at the moment?
Oh, yeah. So I put out 3 of these, most of my followers will know, a week. So, look for an update tonight. I put one out, every Sunday night, Tuesday night, and Thursday night. But I'll give you a little preview. We just had the Fed meeting. As expected, as we've been saying, Jay Powell, because of the Delta variant being, increasing and kind of the reopening being a bit slower than they might have worried about. And because we haven't had as much traction on the infrastructure spending bill as they were thinking, and to the extent that it is moving forward, it's a little bit less than might have been people might have had concern about in terms of inflation, right? Their worry is inflation at this point. That's the concern. Is it transitory or is it real, right? And with those two things going on, and we've seen this, the kind of rotation back from the NASDAQ, weakness to a little bit more strength more recently, last month and a half, 2 months, has kind of calmed down. So Powell, not surprisingly, as we were kind of saying, didn't wasn't particularly hawkish. Like you can break out the bananas, Josh. Like we've been the liquidity has been secured for another month or two, and the party will continue for now. That said, on so many metrics, not only are we overvalued, but positioning is at 99% for hedge funds, for retail, for so many different entities. So, you have to be very cautious here as that liquidity, as they start marching people out and start talking about tapering again, or let's say this infrastructure bill passes pretty quickly and it was on the higher end of expected, right? And we're going to find out in the next month what happens with that. As the Delta variant stuff calms down and places reopen in the next couple months, this is something, to be, there's a midterm effect of where are we going in the next several months. And then there's the next several weeks to month. So right now that flow is back on better than expected by some. On top of that, we're end of month, beginning of month are always the most powerful days of a month, because particularly first day of the month, all the new liquidity from people have been making money in their jobs, and the gains in every fund and asset. We've had a positive month again. All those get reinvested at the beginning of the month. So all those flows come into the market on the first, and there's window dressing at the end of the month as well. There tends to be, because asset managers have a vested interest in things kind of closing into place where they get their payout. So 30th, the first are positive. We're heading into the second part of that option cycle where Vanna and Charm flows should start to take us a little bit higher. First part of August, you have these end of month flows. So short term, very positive. Trend is strong. We're closing there right above the 1.5, or right around the 1.5 today. Standard deviation, we've been closing above it. That's strong. Battling that 2 and kind of pushing up towards there. So yeah, we might get a pullback in the next day or so. Those are to be bought until August 15th, 16th, in my opinion. The 20 days, your trailing stop during that period. And again, be cautious when we get back into that kind of Wednesday of OPEX, next OPEX. That's another time to start being cautious, especially going into late August, early September, which is seasonally weak. Keep an eye out during that 1-2 week period. Be much more defensive, tactical. And then, if we get through mid-September without any fireworks, we can start to kind of get moving again on the upside. So again, this is a watch for signals. Again, several months out, there's reason to be concerned. Particularly watch the Fed very closely and liquidity very closely, because positioning is in a place where you could get some real liquidation if and when there are signs that that's going to really start being removed. Look for counterintuitively economic strength, right? GDP being weak, also very positive for this market. That GDP number had come in at 8.5. I'd be much more concerned, but the Fed going forward is likely to not take away the punch bowl. And at the end of the day, there's a liquidity bubble. It's not about economic performance. The economic fundamentals do not validate these prices. It's all about liquidity. And to the extent there's liquidity, ride that trend. But to the extent that starts getting removed, that's your signal to be very, very careful.
Jim, you talked about going into the next OPEX, like on say the Wednesday before, like August 15th or so, around that time.
Yeah, that's right.
Yeah, you've talked about that before. About there's this window of weakness during the OPEX week. I've heard you've explained it before, but I didn't understand fully when I heard it last time. I'm hoping you can walk us through that again. You talked about vol compression and stuff, and I wasn't quite following. So could you help me?
Yeah. So before you're asking me, hey, are there like getting toy models or things I can use? I don't have all the volume and the information. Mm-hmm. There are trends to these flows, these Vanna and Charm flows. They're not always right? They're trends, but if you're going to try and get the 60% of the occurrence, right, and use that. Generally, those Vanna and Charm flows are biggest going into the monthly expirations of the S&P. Of most of these expirations are the third Friday of a month, right? Our monthly expirations. That's where the majority of the volume still is. That's where a lot of structured products are tied. There's a lot of kind of Vanna and Charm flows then that come off those particular options. So the Vanna and Charm flows are strongest for that, starting at about 2 weeks before those expirations, and they tend to be pretty much done. They increase into OPEX, but they tend to be pretty much done by the time you hit the Wednesday of OPEX. That's not exact science, but there are those trends, right? And those are general trends that you can follow, particularly when there's particularly big open interest, or it's bigger on quarterlies, but also in certain monthlies where there's more activity for some reason or another. That's something that you can take advantage of.
And is the reason for that it kind of dries up on that Wednesdays is just because there's no one left to buy? They're front running it. And
yeah, to be clear, I think window of weakness is actually a bad term on my part. It's not a window of weakness; it's a window of non-strength. That doesn't sound as good. It's essentially these supportive flows that have been coming in, right, are all of a sudden gone.
Yep.
And it doesn't mean that we're going down, right? It's just there's no more upward thrust in the market. To the extent it's a window of weakness is because you've gone up so much, right? You're likely at some level, and these get removed, and there might be some, payback, right? There might be some mean reversion, right? But it's not explicitly negative flows. It's just the removal of positive flows, which is the difference, right?
Mm-hmm.
So, once you get to that OPEX flow end, right? Wednesday, and even sometimes it shifts to Friday, but we get really cautious come Wednesday because that's VIX expiration. At least some of it's come off the table, and most people have moved out of those expirations by then, and the Vanna and Charm flows are pretty much gone from there at that point. Once you get to that window, that's kind of the time to be cautious.
Refrigerator wants to know if Vanna is coming back tomorrow.
So I really speak about it. And you got to understand, a lot of this is to keep myself entertained, because you do this 3 times a week. It's like, might as well make it fun, but also to kind of keep the masses kind of at least engaged, because it can get a little boring day after day. We try to talk about these in more absolute terms and with kind of interesting emojis and GIFs or whatever, but the realities are much more quantitative and much more smooth. It's not like Vanna disappears and then she just suddenly reappears, right? And then is consistently the same. Like I was saying, there's increased strength, but the point here is, once we get to this, the 29th or 30th, right? Tomorrow, the next day, we start, or today, tomorrow, the next day, we end up, this is when those flows start increasing, when Vanna and Charm, and Charm come back and start having an effect again. But the peak is not today or tomorrow. That's just getting started, right? And the peak is really, like I said, it should be. Let me see, when is the peak? I'm actually looking at my calendar here. The week of August 9th into 13th is really kind of the peak. This coming, the second week of the month, right? The week before expiration is generally the strongest week for these Vanna and Charm flows. So, but they're back. They've gone from not being a factor, right? That support being removed, to now coming back and starting to support markets. And so I don't expect a big jump. That said, the more people are conscious of Vanna and Charm flows, the more they start to front run them. There's a little bit earlier effect. So even though the strongest time for those flows is that week structurally, there is a bit of front running that's definitely happening nowadays too. So it's a good time to start hopping on that bandwagon and getting a little aggressive with it in that window, even if those flows aren't as strong.
Fascinating stuff, man. Hey, we were at the hour mark. You got any more time, or you got to check out?
Yeah, I can give you guys another 10 minutes if you need it.
Right on.
Yeah.
Josh, you got anything pressing? You want me to go?
I'd say go with the first question there.
I'm rolling up there. It's a long list. I hope Chris has time to deal with this stuff later. We're going to post all this over to the website if we don't answer it. So, Golden Ratio, it says, thanks for sharing your thoughts and targets via daily Twitter. He's a person that needs to know or needs to do the calculations himself and study the data to understand before he invests. He understands your model has 20 plus variables, but is there a way for a retail trader to elementary calculate GEX on their own? And if so, what do you recommend, or where do you recommend one obtains such data to get a start?
Yeah, to be clear, Squeeze Metrics made the GEX calculation popular. He does it in his own way. You have Howe volatility, you have spot gamma. All these guys do it in slightly different ways, but what they're doing, and like what GEX is, which is not what I do, to be clear, we have a bit more sophisticated model, is they're taking open interest, right, of the S&P and they are assigning some logic based on that open interest of what positioning is. There's a lot of assumptions, and some are more naive and some are a little better, right? But at the end of the day, they're not doing, and it's not, again, nope, those guys are great guys, actually know them all, most of them relatively well, and think highly of them, but and they'll admit themselves, those are pretty basic models. And so people at home can recreate those. They're not, if you can get access to open interest, which everybody can, you can download that and start making your own assumptions based on what that open interest is. That, is that open interest long or short? And some people, some entities do it. If they're out of the money puts, then they're short, and if they're out of the money calls, then they're long, right? In terms of their assumptions on dealer flows. Some do it much more based on the trade level, look at the trades and see if those trades that added to that open interest traded on the closer to the bid or the offer, right? If they're close to the offer, they assume that it was a short, that the dealers are short it, right? And they add it up over the course of a month. These are all things that people can do at home. It takes a bit of work, and you got to be interested in data science, but it's not rocket science. It's not high level math. You don't need a PhD in statistics to go download open interest and make some assumptions on it. And so if you want to check those numbers, you can check them yourself and make your own assumptions. But there are better ways to do it. It takes a lot more data. It takes a lot more understanding of how things work. And but again, that'll get you 60-70% of the way there.
Urge one, what are some ways to properly hedge OTM calls and puts? And would you be so kind as to give even a little more context to the Prince market dynamics in 98 to 99?
Okay. I think I understood the question. Yeah, I'm just trying to think through what they're saying. Yeah. So, hedging out of the money calls and puts. First question. As we talked about, first, using delta the underlying asset, right, is a great proxy. But you always have to be thinking about that options deltas are not hard deltas. There's a difference between hard deltas, which is underlying futures, or soft deltas, which are kind of extrinsic value, right? And what I mean by extrinsic is optionality deltas, right? So if there's an out of the money call, it's not in the money, it doesn't have intrinsic value. It has this expected kind of potential delta value, right? And so you have to be thoughtful about how vol affects that. So as you go up, volatility is likely to decline, especially if you're up towards that 2 standard deviation, or there's a cap on the market. Those vols are likely to decline at that point, and they may not. Those deltas may not perform as well. So, how you decide how to hedge an option is going to be dependent on kind of your other assumptions on vol, and as you get to time's expiration. So you really want to kind of try and map out what you see the trajectory being of where you see the market going, right? To before and these things can be. Again, when you're betting on an option, the beautiful thing about options is there's so much more flexibility. There's so much more ability to bet on the exact outcome that you want, right? And benefit from that exact outcome, to look at your distribution of outcomes and say, hey, I don't know if this market's going up or down, but I feel confident it's not going above here, or I feel confident it's not going below here, or that I think this market may go down, but I don't think it's going to go down much. So I'm going to buy this strike and I'm going to sell this other one out of the money to fund it, right? So it allows you to access to the whole distribution of outcomes. And ultimately, the beauty of that is hedging it. You can hedge to kind of build your exact outcome, and hence kind of really leverage, kind of pay a little amount to make a potentially big amount if you get the right scenario, right? And so I guess to answer your question, it depends what you're looking for. It depends what kind of outcome you're trying to build, and how you want to hedge it. But you really, I suggest kind of thinking about it in those terms, like a distribution of, this is what I think, this is what the market is saying, but I don't think we can go above here, or I don't think we can go below here. And to use those things that you feel confident about to then get your upside or your downside or whatever exposure that you want. So hopefully that answers that question. And then the question about Prince 98, 99 dynamics, the argument there that I've been making, and he's referring to some Twitter posts, is that we're in this last stages of a liquidity bubble. Whether it's the 8th inning or the 9th inning, not sure. But valuations are historic, and the liquidity bubble and inflation are telling us that the Fed will be at some point withdrawing some liquidity from this market. So, if you believe that, which I do, the question is, it doesn't mean we're not going up. We could go up a lot from 99 to 2000. the last part of the NASDAQ rally was about 65% during that year before it declined 90%, right? Or 95%, whatever the final, I think it was 92%. So it doesn't mean that we couldn't go up big. We could go up big still. The liquidity at the end is always fastest, right? So the point there is, at this point, the out of the money calls hedged are too cheap. Again, if you look at that volatility smile, you slide to on a fixed strike basis. Now we're kind of referring to some of the terms we were talking about before, right? To a very low vol out of the money, right? And so you're able to buy an 8% volatility out of the money on some calls. And if you hedge that with short stock, right, which to people like, oh, I don't want to sell stock, the market might go up. Those calls are going to give you leverage on a bigger move. So owning calls is much more powerful for a rally if they think that rally is actually going to be big instead of a tick, tick, tick. The odds of a big rally are actually increasing relative to the distribution. And if you buy calls instead of own stock, you don't have the downside. All you can lose is the premium. So my point here is you're getting to a point where it's really a smart idea to do stock replacement. Owning stocks is crazy at these volatility levels, given where we are in valuations, in my perspective. You can replace that stock with out of the money calls. And so the argument here is whether you're replacing your stock value with calls and still betting on the upside, or you're simply just trying to do a delta neutral. I don't want to be long or short the market at this point. I want to be hedged long volatility. You could actually be short some stock and make a lot of money if the market declines. But if the market increases and at least it's big and you start to get real kind of uptick to that rally, you could actually make money on the upside too. And so the point here is that volatility on the upside is getting really cheap. And structurally, again, the market goes up slowly. It's still not going to do well, right? But relative to the potential outcomes and where we are in this cycle, that's a neat little trade to put on the books.
And is this where you get into dispersions, where you talk about that the index vol is higher, so you sell that vol and you buy cheaper vol from
different trade, right? Not related to the kind of buying calls out of the money and replacing stock, or just doing it outright and hedging it. Dispersion trade is much more of this gets a little complicated for your state, for your futures traders, but I'm happy to dive in. Look, the index is where the vol is supplied, right? And generally, because that's the case, was particularly at periods like this where there's lots of liquidity last couple of days, vols are becoming even more compressed right now. The index is going to have a hard time moving quickly, right? That doesn't mean that eventually that vol compression will dissipate as you rally, if you rally fast enough, because you'll slide to too low a vol, and ultimately people will come in and buy an 8 vol, right? The realized vol will pay for it and will support that level and remove some of that pinning. But in the meantime, vol supplied, oversupplying the indexes, likely to kind of pin the market a bit. And periods during that, a really great trade is to actually, even though vol is low in the indexes, to be short that and long the constituent vols. Not to be long all 500, but enough of the big ones, right? Vols. And why is that? Why would, the difference between the constituent vols and the index vol is actually implied correlation. So the difference is you're measuring how much these stocks are going to move independently relative to the index, right? During times of vol compression, you see significant implied correlation breakdown. The lowest implied vol in history and realized vol in history was 2017. In 225 years of history, it was the lowest, right? Because vol was compressed. It was also, in 225 years of history, the lowest correlations in underlying assets on a realized and implied basis. And why is that? Ultimately, a stock still has earnings. A stock still comes up with a cure for a disease. A stock still goes bankrupt. Something happens. The stocks still move, but the index is pinned. And that vol compression is happening on the index level. And ultimately, if one stock goes up, the other stocks, for the index to be pinned, have to go another direction by arbitrage, right? Mm-hmm. And so implied correlation kind of breaks down in those scenarios. So a really great kind of systematic trade to do in times of vol compression, where vol is oversupplied in the indexes, which is where it tends to happen. Short implied vol in the indexes, be short vol there, long it in underlying assets. And this is a particularly good time for that, actually. Yeah, now we're getting in the weeds. Now I'm turning your futures traders into real vol traders. We're not YOLOing calls anymore.
Yeah, this is fascinating stuff, and I can just see that we are not even scratching the surface.
There's a lot in there, yeah.
No kidding. But I think we're out of time, man. We have a bunch of questions, guys. I apologize. We tried to work through them as quickly as we could, but I will take all these questions. We'll post them over at the Futures IO website. They'll be posted in the webinar thread, and hopefully we can get some answers for you a little bit farther down the road. Jam Croissant, I really appreciate you coming out and hanging out with us, man.
Shane, Josh, this is a pleasure. Always need to kind of be involved with the new group, and happy to come back if you guys want to do it again.
Josh, thank you so much for joining us as well. I appreciate the hand holding.
Thanks for having me.
That was fun, guys. Take care.
Absolutely. Thanks. All right, folks, that's a wrap. Hey, don't forget to subscribe to our YouTube channel and hit us up on Twitter at FuturesIO. We really appreciate you guys showing up. Thanks, attendees. And I thank you for joining us, and trade well.